Welcome back to the channel, or if you're listening to this, welcome back to the podcast. Here for another episode. And today I want to talk about an email that came by my desk a couple weeks back, maybe a couple of months back, I forget now. But it made this very clever comparison between tennis and investing. And if you don't know, tennis is really about the only sport that I was ever able to, be halfway decent at. So I played that a lot in high school. And there was a difference in how the professionals played versus how amateurs like me would play. And so there was this guy that did a study on that, and he said that in expert tennis, like we're talking about the professionals here, a man named Simon Ramo, did some studies and figured out like how these points are won and how they're lost in expert tennis and professional tennis compared to amateurs. But he said in expert tennis, about 80% of the points are won. In amateur tennis, about 80% of the points are lost. Now, amateur tennis would be what I know because I was never a professional, never stood a chance of being that good at all anyway. But it sounds kind of confusing, but what he means by this is that if you watch professionals play tennis, the points are won because one of the players will hit a winner. Like they'll hit it down the sideline, or they'll hit a drop shot that can't be reached by the other player. They'll lob it over the person, or they'll force them to do something to where you can do an overhead slam to win the point, and the ball is not returnable. It bounces off into the stands. You'll see that all the time. It's these winners shots that are made, and that's what wins the point. Now, for the rest of us that would play amateur tennis, you would win your point not so much because you hit an incredible shot that was a winner, or because you served it so great and placed it so perfectly that it was an ace and the person couldn't return it. You'll get those shots every now and then, but with amateur tennis, the way that people win that game, and I can testify to this because this is how I saw it play out with my own time playing tennis, is that if you just hung in there long enough and you kept getting the ball, return it back in play, the other player would make a mistake. They would either hit the ball into the net, they would hit the ball out, they would do something that would cause you to win the point. In other words, you win because your opponent does unforced errors. They commit these unforced errors. And when you lose, it's because you committed more unforced errors. It's a completely different game than it is with how professionals play. Now, there's an analogy that can be drawn between tennis and investing, because I'm sure you're not listening to this podcast or watching these videos because you're very interested in tennis and how professionals and amateurs stack up. But there's a parallel between this type of investing, the amateur type of investing, just avoiding, if you can just avoid making these mistakes, you'll end up letting your other opponent make them, and then you end up winning. That, and compared to how a smarter way to invest. In fact, it's really summed up in a famous guy who wrote a book called Winning the Loser's Game. That's by Charles Ellis. If you're watching the video, you can actually see a screenshot of the cover of that book. You may even be able to read who wrote the foreword by it, Burton Malkiel. Totally could be butchering the pronunciation of that name, but he's the author who wrote another famous book called A Random Walk Down Wall Street, which I would highly recommend that book as well. And it's more of this, where these guys come from, it's more of a passive form of investing. So they're not trying to be like the professional tennis players and do a really good or smart thing, like they, are hitting the winner, so to speak, by picking the next hot stock, or by timing the market, predicting the next recession, and then knowing how to predict when the next economic boom is happening or going to happen. Instead, it's just not doing stupid things, really, is what it comes down to. Just don't commit those unforced errors is what the argument is on this. In other words, go with a boring, diversified portfolio. Don't try to outsmart everybody else, because when you start trying to outsmart everybody else, you have to remember there's a lot of smart people that are watching the market all the time. And there are even computers and algorithms that are running and watching things move constantly. And when you try to outsmart them, you're really going up against people that that maybe they do this for a full-time living. Maybe you're a genius, but maybe you have other things that you do during your life other than just watch the market all day. And so winning the loser's game is all about just trying to not do stupid things when it comes to investing with your retirement and your portfolio in general. Now, the question is how to do this. So there's some very simple things that can help out with this. And I've got a list here to kind of get you thinking about this. First of all, using a boring, diversified portfolio is one way to do this. And I intentionally say the word boring in there because it's not going to be exciting. What long-term investing, if you're doing it the right way, is not going to be exciting. Everybody wants those really quick, short-term gains, but trying to get those and time the market to get those, and then time the market to sell out, take your gains, and then know how to time the market to get back in, is really where you start doing some things that can hurt your portfolio long term. But using a boring, simple, diversified portfolio is a better way to approach this, because then you get exposure to the whole market if you're doing it properly. And if you just ride it out over the long term, you'll probably do a lot better than if you're trying to be the smartest guy in the room and move in and out of the market each month, week, whatever it is. The second one is be content with steady gains over the long term. And this can be very difficult sometimes, especially if you're hearing your buddies or your friends, they're talking about some stock or mutual fund that they bought and how the gains were this much over the last 6 months. And so you can almost, think like, well, if they're doing that, maybe I should be doing that as well. But the thing is, really, nobody tells you about the losses that they took. So they only tell you about the winners. I've experienced this in my own life, talking to friends where they will tell you like, yeah, this thing went up this much. I bought these stocks and this one went up this much. But when you start actually asking about how did the other stocks do, and then you start hearing this other part of the story, well, this one went down a lot. And they weren't really as forthcoming about volunteering that information until you ask for it. So you have to really be content. That can be hard when you see other people that and talk to other people that may only be telling you one side of the story when it comes to their portfolio. And kind of along that same thought process is just to ignore hot tips from the media or the friends. Remember, and I talk about this some on this channel and on this podcast, is that the media, they are there to get you to watch their channel more and more, because the people that pay their bills are advertisers. So if they can tell you what the next hot tip is, or if they can tell you that the next big recession's coming, or do whatever they can tell you to keep you watching, that's how they're going to make their money, because their advertisers are going to pay them, and then they're going to be showing their commercials. So you have to really almost ignore any of these hot tips from the media. If what these guys are saying on TV, and there are certain ones out there that will say, buy this stock, sell this one, when you watch like CNBC and things like that, if what they're saying is actually true, like they have the insight that this is going to be the next hot stock, why would they tell you? I mean, they're going to keep that information to themselves so they can buy it up and take all those gains themselves, and not have other people come and dilute this buying opportunity by bidding the price up to beyond where it's no longer a good buy at a lower price. So you have to kind of ignore what you hear on that as well. And if you really just have a hard time doing this, and you want to have some more excitement going on with your portfolio, if you have to, just set aside, just use small amounts for what you're going to use to do more speculating, as is what I would probably call it. Set aside small amounts, if you need to scratch that itch, and don't put your the bulk of your portfolio in jeopardy for doing this type of behavior and investing. Now, there's a good quote from Charlie Munger, who, by the way, he actually just passed away in late November of this year. But he had a really good quote. It says, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So it's totally the amateur way of playing tennis. Just, if you can just hang in there, don't do anything stupid, don't hit the ball into the net, don't hit it over the fence, all that kind of stuff. Don't try to be the hot shot that's hitting the winners and being very, smart and intelligent as far as the investing goes. It's amazing. He even says, and these are him and Warren Buffett. They were like partners together. They were investing buddies at Berkshire Hathaway, and they were phenomenally successful in how they took long-term approaches to investing, and it really paid off for them as well. So some of the key takeaways from this is diversify your portfolio, make sure that you're getting exposure to different areas of the market, allocate it based on how much risk you can stomach. If you're taking more risk in your portfolio than you can handle, then what ends up happening in reality is that if you're taking more risk in your portfolio, that means it can go up a lot, but it can also go down a lot. And if you can't stomach those downturns, or at least to the extent of how volatile your portfolio is, in reality, what's going to happen is you will get scared. You will end up making a decision to sell when you've taken big losses and not be around when the gains come back. If you think about back in 2007 and 2008, this happened to a lot of people when the market went down. S&P lost almost half its value. If you didn't hang in there, then you weren't around for it to rebound back. You just lost the money. So if you can't stomach the risk in your portfolio, just take a more conservative allocation on that. But also, when you're talking about allocating, you also have to allocate it based on your long-term needs in retirement. So if you're looking at your numbers, and this is probably something you're going to look at if you're looking with a financial planner, and you're forecasting out, what type of spending needs do I have? And that may involve that you need your portfolio to be growing a certain amount each year in order for you to have a successful retirement. Then you want to make sure that you're also allocating that portfolio to even have a shot at growing that much. So it has to take enough risk that it can get enough long-term growth potential going forward. And if all of this is kind of daunting to you, maybe it's something that would frighten you trying to do this, or you're worried you might make a mistake on this, and I'd highly encourage you to talk to a financial planner that can help you to set up this type of portfolio and help you to stay on course going forward with it. I mean, your retirement is that important. It is worth it. And as always, if you need any additional help with your retirement planning, one way you can do that is download a free copy of our essential step-by-step retirement guide. You can easily download it at retirementplanningmadeeasy.com. I'll add you to my email list so you'll get updates from me and also the contact info if you need to get in touch with me in the future if you need any additional help with your financial planning. That's all I've got for you for this episode. I'll see you guys on the next one. Have a good one.